All right, so I'm happy to introduce and welcome our guest speaker for tonight, Ryan Lantz. And Ryan is the Chief Financial Officer of Valicoff Fruit Company, Inc., a mid-sized vertically integrated tree fruit producer in the Yakima Valley. Before making the move into the agriculture industry, Ryan spent over 10 years working in healthcare. Most recently, he was the Director of Financial Planning and Analysis for the Virginia Mason Memorial Hospital System, where he designed, built, and led the FP&A team for the enterprise. We'll get Ryan to tell us what the finance. We'll get him to tell us what FP&A is.
Financial planning and analysis.
There you go. All right. FP&A team for the enterprise. Prior to Virginia Mason, Ryan worked for DaVita, a Fortune 200 international healthcare company, in a variety of roles throughout corporate and operational finance, as well as clinical operations. He earned his MBA and a BA in finance from Washington State University, go Cougs, and currently serves on our WSU Entrepreneurship Advisory Board. Ryan enjoys spending his free time with his wife and 3-year-old son, especially if they're doing something outdoors or rooting for the Cougs. Thanks so much, Ryan, for joining us tonight, and we'll let you share your slides and take it away.
Awesome. Thanks, Marie. What a fantastic intro there. Asa, is that a tractor behind you?
No, that's like in front of the library. You probably didn't spend much time there when you were at WSU.
I see. That's close to the bookman. The book. Okay.
It's just one of the prefabbed WSU Zoom backgrounds. I have other ones, but that's the one we're using today.
I also just want to remind everybody that if you guys can share your screen, you can share your picture. We'd love to have you all on screen so that Ryan can see you as he's talking.
You might recognize this background a little bit better, Ryan.
Yeah, I recognize that one a little bit better for sure. All right, yeah, I'm just expanding out all the screens there so I can see everyone. Cool. Yeah, thanks Marie, thanks Asa. Really happy to be doing this. I'm very excited about financials, and anytime I get to share my knowledge on that. So not only am I a Coug alum, but I'm a business plan competition alum as well. So I think it's been 11 years since I've been sitting in many of your shoes that you're sitting in now. So I can I can understand the pain that some of you are probably feeling right about now, trying to figure all this out. So my goal tonight, there's a lot to get through, but I'm hoping to make the financial component a little less scary, and just give you a little bit more knowledge about how to tackle all this. So with that, I've got 24 slides, and I'm going to try and do this in 30 minutes, which means I have 1 minute and 15 seconds per slide. So I'm going to be moving through this quick. If you have questions, pop them in to the chat, or save them for later and we can talk later. I'm going to drop a link into the chat right now, and that is the template. So later in my presentation, I'll be going through some details and actually referencing this template that I went ahead and put together some examples through. So if you want to download that template, it's a pretty good starting point, and we can kind of go through that together so you can see what I'm working on as we go through it. All right, with that, let's jump in. Okay, so quick disclaimer, I'm not a CPA, I'm not a financial advisor, I'm not a lawyer, so this is just general guidance. If you need help specifically with any of those areas or financials or accounting specifically, make sure you talk to a qualified professional. Okay. So objectives tonight is really to get you to your endpoint, and hopefully a little bit beyond. So for the business plan, you should already know you need a statement of cash flows, an income statement, and a balance sheet. So a 5-year pro forma. So a pro forma is just another word for a projection. So a 5-year pro forma. The judging criteria based on the different rounds, you need to make sure you're displaying your pro forma for revenue, expenses, and net income in a chart for your screening. You want to be able to describe where you're getting your money from, which customer segments. You want to make sure your financials are consistent with your overall plan and that your assumptions are realistic. So we'll hit on all that and more as we go through this. Okay, but before we jump in, first, George Box, he's a famous British statistician, and he said it best: all models are wrong, but some are useful. So that is the goal as you go through this financial exercise for building out your financial picture for your businesses, is to make it as useful as possible, because there is no such thing as right. There is no such thing as perfection when it comes especially to projections. So just keep that in mind. The goal is to make it as useful and as accurate as possible, knowing that you will never actually achieve it 100%. Okay, so set the bar a little bit lower for yourself if anybody was worried about this to start out. Okay, so we're going to start with the basics. I'm hoping most of you already have a general understanding of the basics, but just in case, we'll go through it. So the statement of cash flows, it's the most literal statement of the three. Okay, it's literally cash received minus cash paid out over a period of time. So it's going to help you project whether your cash receipts, the money coming into the business, is going to be sufficient to cover your projected cash disbursements, the money going out of the business. So that last bullet, cash is king. Everybody should write that down. As you're starting a business, you should remind yourself daily, cash is king. If you run out of cash, you're dead. So you got to pay attention to your cash flow statement. This is one of the most critical statements, especially as you're getting started in your business, because you have to make sure that you have enough cash to continue to fund your operations. All right. So there's an example statement there on the left, and it's just real simple, starting from sources of cash, the cash coming in, to the uses of cash, the cash going out. One thing to note on the statement of cash flows is, like I said, it's literal. So it's literally the month that you receive cash is the time that you would report it. So if you make a sale of $10,000 in January, but you don't receive that cash until March, you won't show it on your cash flow statement until March. Okay, so think of the cash flow statement very similar to like your bank statement. All right, it's going to show you what's coming and going at the exact time that it's happening. Okay, because again, if you run out of cash, if you miss up and you don't get your timing right, and you run out, then you either need to find funding, you're going bankrupt, or you're going to have to pay a bunch of overdraft fees and other stuff that is not going to be fun. So manage your cash. Income statement and profit, or the income statement, also known as the profit and loss statement, also known as the P&L. So this measures revenues and expenses over a period of time. It's going to tell the story of the financial story of your business activities. This is the best tool for knowing if your business is actually profitable or not. So thinking about the cash flow statement, if you make a sale in January, but you don't receive the cash until March, now you've got the sale and the cost that it took you to make that sale, the cost that it took to build the product, whatever it is, in January. You took all those expenses, and then you didn't get any money for it until March. So now you've got a mismatch. So you see that last bullet there on the slide, the matching principle is what applies here to the income statement. So the income statement starts doing a little bit of accounting adjustments to make sure that your revenues and your expenses tie together as much as possible, so that it gives you the clearest picture of if you are actually making money on the things that you are selling or not. Okay, so that's the biggest difference between the cash flow statement and the income statement, is really going to be that timing piece. So using that example, if you made a sale in January, but you didn't collect the cash until March, the income statement would show that sale in January. You would show the revenue in January. Okay, and that way, again, you can say you made money and you spent money, and then your profit was X amount. So it gives you a nice, clear picture of if the business is making money or not. So cash flow is all about cash. Do you have gas in the tank? Yes or no? The P&L, it's all about measuring your profits and trying to clean up some of that timing issues that can come with cash. Then the balance sheet. The balance sheet is, in my opinion, the most abstract of the financial statements. But this is the statement that is going to give you the best idea of the value of the company. So it's looking at all of your assets. So think assets starts with an A. These are things that add value to the company. And then you're going to have your liabilities. So an L, things that are leaving, right? Like value that is leaving the company. Okay. So these are the money that you owe to people, debts that you owe, bank loans that you're going to have to pay back. And then the last piece is that stockholders equity or the owner's equity. So how much value is left over after you take all your assets, the things that are adding value, you take out all the things leaving, money that you have to pay out, what's left, and that gives you that valuation there. So this is a good way to determine the net worth of a company, quick overview of the financial health. Bankers love this statement, and investors would look at it as a pretty big foundational component for doing a valuation of your company. Okay, so those are the financial statements. I think that went a lot faster than I had practiced, so that's good. Hopefully I didn't lose anybody, and hopefully nobody's passed out from stress yet. So we'll keep going. So we're going to start building the financials. So I'm going to use an example. I actually have, this is not real. We have a really awesome proprietary coffee mug, and let's say, it's state of the art and changes colors with the temperature of the mug and does all kinds of cool stuff, washes your clothes too. So we're going to start a coffee mug sales company. We'll call it Coog Mugs. Okay, so this is, again, I pasted that link in the chat. That's a lot easier than going through these steps here. But those are the steps to get to that financial projections template. Just a side note, that score.org, they have a ton of other financial templates that would be really useful, and I would recommend you guys go check it out. So Coog Mugs LLC, we're going to start with a sales forecast, okay? And that's going to be pretty critical, and I would strongly encourage all of you to start with your sales forecast. So you need to know how much money you're planning on making, how you're making that money, and then the rest you will have to figure out how that all folds together, okay? But if you can't figure out how to have sales, or you can't get a good projection or a strong idea of what that future sales looks like, then there isn't much else to talk about. So you need to start there. So then we'll go through COGS, which is cost of goods sold, and payment terms. We'll talk about payroll, go through the startup and operating expenses, and then some other considerations. Okay, so this was my sample template, me filling it out for Coog Mugs. So in the template, you'll see, there's directions on how to use it. So I won't go through all of that. I also am not going to spend a lot of time talking about Excel. Hopefully you guys have some, basic understanding of how to use Excel. Note that with this template, I would recommend you go through and you unlock the the tabs so that you can move stuff around. Just be careful when you do that, because there's formulas and different things that are already set up. So make sure you're paying attention to what you're doing. And we'll talk about this more, but these templates, any template that you use, you're going to want to go through it once, review it, see how it all works, go through it again, review it, see how it works, start making some changes to set it up how you want to look at it, so that it fits for your needs, and then double check it again to make sure that nothing got broken, none of the formulas got broken, things are still pulling through. So all of that, just be careful anytime you're in Excel or any one of these spreadsheets, that things are flowing how you want them to, okay? So for our example, we're going to sell retail mugs and corporate mugs. So in that top left section, I just made up a unit price of $10 and $5. We figured the corporate mugs they'll sell on volume, so we'll give them price discount. The cost of goods sold, which we'll talk about in a minute, is coming in. That says $1.45, and so our margin is $8.55 a unit on the retail and $3.55 a unit on corporate mugs. So notice how it's already talking about per unit. So all of you, if you haven't already, you should be sitting down and thinking through, and we'll talk about this more in a second, the unit economics of your business, okay? So what is that unit, whether it's a particular item or a group of items or a group of services, knowing what those unit drivers are, Okay, so for our example, I just said, and you can see my assumptions down below, retail sales, we're going to do 10 new stores a month that we're going to sell to. Each store is going to buy 10 mugs on their initial purchase, and they're going to turn over their inventory every 3 months. And so just building that out into this projection, you can see, so this is my first year unit level projection for retail mugs, and then assumptions on corporate sales. I'm going to estimate 500 mugs per business, per customer that we acquire. And we're going to do 1 customer a quarter through Q3. And then starting in Q4, we'll do 1 customer per month. Okay. So the theory kind of behind this, unit economics, breaking it down. Okay. We're starting with customer and product segments. We've already taken a mug and we've categorized it into 2 different segments. So those are 2 very specific, segments of customers that are going to require different sales strategies, and financially they will behave differently. Their volume projections will be different. You will have different assumptions going into those, and so you want to break your business down as much as you can into these unit level or segment level concepts. So identify, once you have your segments, identify your segment drivers, and then identify the drivers of your drivers. So we would start talking about, we're trying to project units sold. How do we project units sold? How do we get a good assumption that an investor will agree with to say, if I go back, I'm saying I'm going to do 3,300 retail mugs and 3,500 corporate mugs in the first year. The first question is, well, how did you come up with that number? Okay, so we said we're going to do those numbers for units sold. Okay, then we break it down. That breaks down to customers acquired. So we said we're going to do 10 stores per month, and each store will buy 10 mugs every 3 months. Okay, so those are assumptions that are broken down. They're digestible. You can explain that, and hopefully you have some information to back up where you came up with that number. Okay. And then getting into like the corporate side of it, maybe we talk about hiring a sales rep and saying that a sales rep will be able to acquire more customers, and we can set expectations for that sales rep and say, if we have a sales rep, the expectation is that they will be acquiring 1 new customer per month and 5 new stores per month. So then you can tie together, when we get to payroll, you say, I'm going to hire a sales rep. Now my sales are going to go up because I hired that rep, because of my unit economics that are all tied together. Then that just, it makes it more logical when you're explaining it to someone, you're explaining it to an investor, they can digest that, and then they can test each individual assumption on its own, right? If you just said, I'm going to do 3,500 units in the year, they might go, nah, that's never going to happen. You say, well, actually, here's the plan. We're going to hire a sales rep. They can do X number of customers a month, and they'll go, okay, yeah, that seems reasonable. And we think each customer is going to buy X number of mugs per month, and they'll go, okay, yeah, I think that seems reasonable. And then you say, and then that's how we get to 3,500 mugs. And then they go, okay, that seems reasonable, right? So it's all about breaking it down into these reasonable, digestible components that you can explain and back up, okay? And then I already talked about this, but determining rates for each driver. So you're talking about customers per sales rep, units per customer, units per month, and then you obviously have your price per unit, which will then populate all of your financials as far as revenue goes. So use data, be creative, think outside the box about how things are connected and correlated, and especially when you're trying to get data to back up your assumptions. I think I remember this website where you could go pick 2 different things that were totally unrelated, and it would figure out how they are correlated. So you can draw a correlation with just about anything, but you got to make sure it's reasonable. Okay, just because 2 things are tied together does not necessarily mean that there is a cause and effect relationship there. So it's all about being reasonable. So once you come up with these assumptions, test them, right? Run it by your friends, run it by your parents, run it by whatever advisors you have to talk through, hey, does this make sense? And again, if you have it boiled down to these individual assumptions, these minute components, then each one can be tested individually as long as you know that they have a nice tie to each other. So hopefully that makes sense. This is probably the most critical point of your entire business plan, is making sure your market plan, your go-to-market, all of that is consistent with your sales plan. So all of that should tie together, okay? And this is where you're taking those marketing plans and you're putting numbers to it, all right? And so again, you talk about volumes, you talk about units, and then you get to your price per unit, which will then flow into develop your revenue. All right, let's keep going. I don't see any questions yet. Okay, so next is gonna be cost of goods sold. So this is where you just need to do your research. I just, and you know, this is my very rudimentary presentation. I would hope none of you have something this horrible for your actual business plan presentation. I'm sorry if I offended anybody who does have something that looks like this, but you might want to take another look at it. But my basic assumptions are listed there at the bottom. So raw materials, we're saying mugs are going to be 50 cents a mug. And we need ink to print on the mugs. That's going to be $300 per 1,000 mugs. So again, those are unit economics. Okay, so if we know what our per mug cost is, all I got to do now is go back to my sales forecast and say, I'm going to have 1,000 mugs. So 1,000 mugs times 50 cents. Now I know what my raw material cost is for mugs. So same thing for ink, right? So figure out what it is per unit as much as you can. Asa, am I supposed to be reading this? Where can I go get some market averages for my?
I'm just getting it started. I'm just priming the pump there, Ryan.
Oh, okay, good.
If you got any resources for sort of market reports or industry verticals for reasonable, you know, like, because you said reasonable assumptions. So, right, we want to make sure things are reasonable. Reasonable would be look outside of your organization and look at what is the market doing, right? So if you know of resources, or if you want to drop them in the chat, or we can follow up with an email, that would be, I think, valuable for these guys.
Yeah, that's a great question. And I would say, you know, the first thing is that it depends on your business. It depends on your industry. So some industries have some of this stuff well published, and there's a lot of research and a lot of materials out there that you can go look up and find some of this information, and others don't. I would say one of your best places to start is to find another large company that does something similar to what you're doing, and go pull their 10K report, go pull their SEC filing, where you can go look at their financials, and their financials will talk about their units. So if you're in hospitality and you go pull up Marriott, they're going to talk about how many hotels they have, how many room nights they have, things like that. And you can get a rough estimate of their per unit costs just by doing the math on their financials. So that's a good place to start. The next place I would say, because I don't know of any specific research outlets off the top of my head, but if you can find somebody who works within that space and just ask them what they know. And if you can get 2 or 3 different points of information, you should be able to dial in a pretty reasonable number, is what I would say.
Awesome.
So, yep. And especially when it comes to things like cost of goods sold too, hopefully you are calling up distributors and vendors and talking to them. A lot of these guys will actually give you quotes, especially if you say, hey, I'm a student and I'm doing this project. You know, some of these vendors will drop a quote for you, and that's a fantastic thing to put into your business plan and say, I already got a quote from this company that's a legit manufacturing company that said it was going to cost this amount. You know, so you can totally back up your assumptions. And that one right there almost isn't an assumption, right? Because you have an actual quote. So the closer you can get to real, the better. So anyway, going through with the template, you just fill in these components. So and I changed it up and added some rows to make it work for Coug mugs. So we've got mugs, we've got printer ink. So labor is an interesting one, and this particular template is a little tricky because it has its own HR payroll tab, but then it also has labor inside of the cost of goods assumptions that you put together. So make sure you don't double count when you're going through this. So, and it just depends on the template. This particular template doesn't have this part outlined very well. So we'll talk about payroll in more detail in a moment. But again, my assumption with labor used is that I said, okay, if I had 2 employees working 8 hours a day, they could produce 1,000 units. So you see 1,000 is my number of units sold in the time frame that we're listing here. So if that's the number of units I'm talking about, then every number above is in the per 1,000 units, okay, or per 1,000 mugs. So what I say is how much labor do I think it's going to take to produce 1,000 mugs? So 2 employees, 8 hours a day. Maybe I did some time studies or something to back that up. So I've got, something more hardcore than me just making this up. So that's going to be 16 labor hours to produce 1,000 mugs. And then I'm going to plan on paying my employees $14 an hour. And then I'm going to assume about 25% on top of that for tax and benefits. Okay. And that's how we get to the $291. And then again, just assumptions for costs associated with shipping and storing, packaging. So you got to think through what are all the components that are going to go into the product or the service that you're selling. What are those costs? And be thinking about this in terms of direct costs. So if you have a lease or rent payment, that is not a direct cost, right? You're going to pay that whether you make your product or not. So you want to think about what are the costs, the variable costs that will increase with every product I produce. Okay, so that's what the cost of goods sold is really trying to get you to dial in.
Hey, Ryan.
Yeah.
I just want to jump in. We got a question in the chat about what would be more equivalent to a software business or something that's a little bit harder to draw a box around the unit economics. So when you're talking about sort of cost of revenue as a more ubiquitous term as cost of goods sold, what things do you include in your unit economics when you're thinking about COGS for a more squishy business model, such as a software business?
Yeah, that's a good, that is another good question. So I'll start with the theory. The theory is that you want to get, and this kind of goes back to the income statement, because the income statement tells you if you're making profit or not on what you're doing. So the income statement starts with revenue. And then as you go down through expenses, you want to be starting with the most direct expenses that are tied to that revenue. So be thinking about what is it that's going to be generating you revenue. So if you're doing an app or something that's more software based, are you getting it through ad revenue? If that's your primary driver, or are you getting it through subscriptions? And so you think about what is your driver of revenue, and then you start thinking about your expenses and what are the expenses that are most directly tied with that revenue. And the best way to think about this is to think about if the revenue went away or the product that you're selling, if you were to stop and halt operations, what expenses would stop at the same time, right? Or vice versa. If you were to cut off an expense, what would halt your revenue? And so trying to draw that relationship is pretty critical. And that's where you get into this really being able to identify variable expenses and direct expenses. So like that example of rent, if you stopped doing work and you got rid of all your employees, you would still have rent. Presumably you're in a lease agreement. And so that is a very indirect expense. And this is, I like how Asa said squishy, because this is squishy. The financials, there is no book that says this is literally, here's every possible expense for every possible business, and this is exactly where you have to book it. There is an art to this, and that's where it's really your job to spend the time to think about, okay, what are those expenses that are directly tied tied to my revenue. So now that I'm thinking about it more, maybe you have server costs. And I would say that those server costs, even though you might pay it per month, or you might have a more longer term agreement with those server costs, those you can't have your revenue without that server. So you might be able to say those server costs are directly tied to my sales and to my revenue. The programmers who are doing the work to get the app up and going, that might be tied to that as well. So I know it's not a perfect answer, but hopefully that helps a little bit. Let me know. We can talk more if we need to.
Marie's got a quick question, I think.
Yeah.
We had a number of students register tonight, which was exciting, that were involved in the ag industry or in the tree fruit industry. And since that's the industry you work in now,
Mm-hmm.
Ryan, I'm curious, when you do like how do you do cost of goods sold for a piece of tree fruit, for example?
Yeah. That's I spend every day thinking about that. So it depends. So in my bio, I described Valicoff fruit. It's a vertically integrated tree fruit producer. So that means we have growers who are growing the apples. We have a packing facility that packs the apples, and then we have a sales desk that sells the apples. So that's our vertical integration. And so it depends on what segment you're looking at. So if you're looking at a farm, the cost of goods sold, and this is where income statements get real tricky, and farmers rely very heavily on cash basis accounting. So I won't get crazy into that, but they're putting in fertilizer, lots and lots of labor, water, other types of things to actually grow and produce. And this is, I've been having some discussions with our accountants actually about talking about, can we take some of those expenses and put them in our books almost as inventory, right? Because if you think about manufacturing, if I were to build an apple, right, if I were to build a product, I would be buying nuts and bolts and metal and different pieces. I'd put them all into storage off to the side. That would be my inventory. I spent all this money, and now I have inventory as an asset on my books. And then as I take that inventory, my raw materials, and I process it into a good that can be sold, then it transfers, right, in financially, and then I can sell it and make revenue. The problem with farming is that you spend all this money and you put it into the land and the ground, and it just goes away as an expense. And so for an industry that's been around since the beginning of time, practically, it's kind of funny that their financials aren't as well figured out. But probably the better view of that is in the packing facility, and that is it's really labor and boxes and other packaging supplies that go into that, and that would be our direct cost of goods sold for that. Even though the packing facility didn't make the apple, right? The final output is the box of apples, and so it's the materials that really went into that. So labor and supplies. So hopefully that.
Thanks. Yeah, that's helps.
Yeah, that's a good one. You're getting me all excited about.
It sounds like the short answer is it depends.
Yeah, just like everything, right?
Yeah, exactly.
Yeah. Okay. I'll keep moving. You guys keep me honest on time. But so payment terms is another thing you got to think about. So AR, your accounts receivable, how long are you going to allow the people that you are selling your goods to, how long are you going to allow them to take to pay you back? So standard usually is 30 days, but again, it's industry dependent. So it does depend on what you're doing. If you are selling, something that is, very expensive, then you'll usually put together some type of a payment plan for those customers to pay you back, because you wouldn't expect them to just shell out $100,000 within a month to pay you. So you might give them 180 days to pay that back. So the more expensive it is, usually the longer the tail, the lower the price per unit. Usually the shorter the payment terms are. And so this template's nice that it's got set up. You can come in and put in, I expect 80% of my sales to be paid back to me within 30 days. So this goes back to your cash flow statement. So now if you make a sale, if you sell somebody something that's costs $10, then 80% of the time you should get that $10 back within 30 days. So you can plan to have that cash back in hand to cover your expenses. So you go through this, and again, depending on your industry, put in an allowance for bad debt. Generally speaking, you're going to have bad debt. There will be people who end up not being able to pay you for whatever reason, or even if you feel like you're in a very secure industry and people make their payments, you never know when a business might go bankrupt, and then you're out, and you can't collect your money. So it'd be smart to put in an allowance, at least a couple percentage points. But I would do some research on your industry to see what some standards are. And then accounts payable. How long are you going to take to pay your vendors back? So again, this feeds all into the cash flow statement to try and get a good idea of how much cash you're going to have coming in and when, and how much cash you're going to have going out and when. Okay, so we pretty much tackled all that. So cost of goods sold, make sure you develop a full breakdown of costs. You want to end up with the total cost per unit. Payment terms, yeah, we talked about that. Okay, so payroll. So again, you can see a theme. I'm putting together my template, and then I've got my assumptions down below. Not saying this is how you should do your presentation, but this is the idea that you should be going for. You should always have assumptions to back up the numbers that you're putting into your financials. So in the case of Coog mugs, we said, okay, we're going to have one owner and one full-time employee. But I'm saying, so if I'm the owner, you know what, I'm going to go without pay for the first 6 months. I'm going to say until sales break $5,000. Now, somebody should say, well, where'd you get $5,000 from? And maybe, hopefully, what I did was I did a cost breakdown to say, well, once we hit 5,000, we make enough profit that we can cover, spending some money and or giving myself a salary. And that's how I came up with that number. And then for the full-time employee, we're saying, okay, it's going to be July of 2022 to support continued growth. And then we expect them to acquire 5 new retail stores per month and 1 business per month. And so again, that ties back into my sales forecast. So these should all align and make sense from that standpoint. And all I did, by the way, is because the template just fills all this stuff out. So I just went in and I deleted the cells that I wanted to be 0, and I reset the formulas to pull in the numbers that I needed. Okay. So just spend time with the template. And if you don't know Excel or you're scared of Excel, go wander around Todd Hall and you'll find some Excel nerd there who can probably, help you out. That's what I just hung around in Todd Hall all day when I was there, just waiting for somebody to ask me an Excel question. So payroll, based on your volume projections, how much staff will you need? So using those unit economics, okay, you don't want to just make up how much staff. You need to have a basis for why you need that staff and what you're going to get out of that. So how many customers per month can a sales rep acquire so that they're supporting your sales plan? How many units can one employee produce per hour, per day, per week, per month? So depending on your business, looking at labor costs per unit is very important as well. So just a side note, 1 full-time employee on average equals 2,080 hours per year. So just for the
0
quick math.
Vacation time.
What's that?
That's 0 vacation. That's 50.
That's assuming they get paid vacation. That's assuming
okay.
they get paid vacation. Yeah.
Gotcha.
Yep. So yeah, research appropriate compensation for each position. Are you going to pay your sales reps base salary plus commission only? So there's a couple different ways to look at that. Washington State minimum wage is $13.69. So don't assume you're going to pay your people less than that. That'll be a major ding. But you should think about, are you going to pay your folks a premium? Maybe you want to be, a better, have that as a better recruitment tool to pay a little bit more. Owners do need to get paid at some point. So be thinking about, and again, run the numbers to figure out where it makes sense in your forecast. But at some point, you do need to be establishing yourself with with a salary to take home, even if it's just minimum wage. There's a couple pieces to that. One being you want your books to be fully loaded. So when you go to sell your company, somebody's going to pull it apart, and then they're going to go, oh, well, you haven't even been paying yourself. I'm going to have to hire somebody to do what you've been doing. Now I've got an extra $100,000 a year that wasn't in your books. So that's one piece of it. The other piece is that just for like, what am I saying? Payroll taxes and things like that, income taxes. I'll let an accountant explain that one to you, but there is a benefit to getting yourself to be paid through the business. So don't forget about payroll taxes and benefits. The assumptions standard, and as far as I've seen across most industries, you want about 15% for payroll tax, and then depending on how much benefits you're going to be giving your employees, probably about 10 to 15% for employee benefits. So you should be right around that 25 to 30% on top of their wages. So that's 15% of their wages and 10% of their wages that you should be assuming. Okay, hang on. There's a note here, Logan. Let's see. Typically, sales and integration costs. Remember, though, one of the things that makes software attractive as an industry is lack of cost of goods sold. Yep, and therefore typically higher margins and profitability. Absolutely. Yeah. So that you are correct there. And if your income statement ends up looking really simple, that's okay. It doesn't have to be complicated. Okay, it's just about capturing everything and being able to present it in a way that makes sense. Okay, so startup and operating costs. So again, the template's got a really nice setup to make you put in your startup costs. So that's what I'm showing here on the left. So for Koogmugs, we're not buying any land. We're not going to do a build out. So, but if we were going to open our own store, we would want to look at how much it's going to cost to build out that store and put in all the light fixtures and the flooring and everything that we want in that store. That would go into leasehold improvements. Equipment, let's assume we're going to buy ourselves, we're going to buy the mug printer ourselves, and that's $20,000. I'm probably going to need a laptop so I can, email my customers and do all that. So that's going to be $1,500. We probably need desk and chairs. So again, going through and being reasonable, you can't just say, well, this is sort of a hypothetical thing that I'm doing, so I'm not going to buy any of this stuff. Well, then your financials don't make sense, right? Then they're not painting the right picture. So you need to be as realistic as possible going through this. Operating capital, looking at prepaid insurance premiums. So that's one thing, you're going to need insurance. So, and again, a lot of these insurance companies or insurance brokers will give you a quote, especially same thing I was saying before, as a student group, you could go and say, this is what I'm doing. Can you give me a quote for a business like I'm talking about? And they'll actually probably ask you some pretty good questions that maybe you haven't thought about. So I would really recommend everybody going and doing that. And trying to get an insurance quote, and they'll put on there that it's just a draft or, it's not real. But then you've got something hard and tangible to back up these assumptions. So in our case for Koogmugs, we'll have to buy inventory. You're going to have legal and accounting fees. So make sure you account for that. If we had rent, we would put that in here for a rent deposit. So these are all startup. This is the stuff that's happening before you even do your first sale or open your doors, okay? And then on the operating cost side, again, it's just going through and making sure you're listing out all of the potential costs, because there's going to be stuff that you maybe didn't think about. So go read through lists of other startups and what their costs are to make sure that you're capturing everything. And you want to be, and this is where the art comes in, because you don't want to just overinflate everything, because you're like, well, I don't want to miss anything, so I'm going to say, that my rent's going to be $100,000 a month. You just got to try to make it as reasonable as possible. And this just goes back to, you're going to go through this whole template, the whole build out process of your financials. and you're going to just put in numbers to start, and then you'll come back through and review them and test them for reasonability, and see if they make sense to you or not. So it's going to be an iterative process. Just know that you're going to have to come back through this multiple times before you get ready to submit your plan. Okay, so I think we hit on this. Startup costs. What will it cost to get your first sale? So the key things: buildings or build outs, furniture, prepaid expenses, your inventory, supplies, any licenses. And then I didn't actually mention working capital. So that goes back to your cash flow. If your cash flow shows in 3 months you're going to go negative, well, you better have a plan to have some cash in the bank so that you don't go negative. Okay, so you're gonna have to, again, go through that cash flow statement, look at what that looks like, and then probably come back to your startup costs to figure out how much cash you need and what you're gonna put into it. Operating expenses. So what are the ongoing expenses to operate the business beyond the cost of goods sold? So hopefully those costs are already captured in that cost of goods sold per unit that we talked about and set up. And so these are the things that are layering on top. And I typically like to think about expenses in terms of, are they one-time expenses or are they recurring expenses? So segmenting, so one-time versus recurring. If they're recurring, is it monthly, quarterly, annually? So you've got an idea there. So when you go to plan out your operating expenses, you know to put them in, what months you need to put them into. And then looking at, is it a fixed expense? So rent, it's going to be $3,000 a month. No matter what happens, $3,000 a month, you can just plug that in. Or is it a variable expense? So some costs that aren't direct expenses, but they could still be variable, will go up and down with your sales volumes. And then you should be asking yourself, should it be included in cost of goods sold, or is it indirect enough that you would leave it out? Okay. All right, so we've done all that work. So now let's look at the story that it tells us. And that's pretty small, so hopefully you can all see it, but this is our balance sheet that we just went through and built. Okay, so what does this tell? And I guess before I even go there, you'll see I'm already falling short of the objectives that we outlined at the beginning, and it's only 3 years. It needs to be 5. So again, we would need to go through and modify the template to include those 2 additional years that we're going to need. Okay, so the template is just a starting point to get you set up. So you'll see, based on our projections, the balance sheet shows we're going to have no cash at the end of 2022. So if you remember, the balance sheet is a snapshot in time. So these are all as of the end of the year. So December 31st, 2022 or 23, 24. So this shows that we're going to have no cash. We're going to have accounts receivable. So we've made sales and money will be owed to us. We're just not going to have any cash in the bank. We'll still, have about $800 worth of inventory, and we will still have about $6,300 worth of prepaid expenses. So I won't go into how the prepaid expenses works. That's an accounting function where you're amortizing your expenses. But just know some prepaid expenses you actually can put on the balance sheet. So this template does it for you, which is great. We get into fixed assets. We've got our computer and our printing machine. We've got our desks and our desk chairs. So we get to put those on as assets, because if somebody bought the company, we would want to be able to say, hey, I bought that. That is part of the company. So you're going to get it. So you should pay for it. So it's accounting for all of the different things that are, again, adding value to your company. Then you've got depreciation that's coming out. Again, that's a whole nother conversation. Luckily, the template does it for you. If you have questions about depreciation, we can talk through that later, or you can go find an accounting student who maybe can explain it to you. And then you get down into liabilities. So what do we owe? So accounts payable, we're paying all of our accounts within 30 days, so we owe nothing, but we've got a line of credit balance. So I'll show you here in a moment where that came from. And then you get down into equity. And if I go back up to my my startup costs, you can see my total required funds to start up was $35,000. In the case of Coog Mugs, I'm saying I'm putting in that $35,000 to start and pay for all this stuff. And so therefore, it comes out and says that I put in $35,000. That's my equity stake in the company. And we'll see here in a moment that the company lost money in 2022. So my retained earnings, the earnings are going down. It's negative, so not looking great. But we can see by year 3, things are starting to turn around, and our total equity is starting to drive back up. So that our initial $35,000 that I put in now is up to $72,000. Okay, so that's the balance sheet. So then the income statement, again, we're only showing 3 years. But just an idea of what you might want to be looking at presenting for your business plan. And I'll pause there for your detailed plan. And if this doesn't align with what you've been instructed, then please correct me. But I would very much recommend that you put in a detailed income statement. So, and detail is, again, it's sort of ambiguous, but I would say something like this, where it's line iteming out licenses, rent, supplies, as specific as you can get, so that the judges or the investors can go in and look, because those are all your assumptions that you're putting into your financials. So provide that in as an appendix or something like that in your actual business plan, and then you'll summarize it for your presentation and for your one pager or whatever it is that you submit for screening. So if we look at the income statement, we can see in year 1, we had $50,000 in sales. Cost of goods sold was, it was 20% of our revenue. So that means our gross margin was 80%. Hey, those are great. That's awesome. Good margins right there. Oh, but our payroll was 161% of revenue. That's not good. Okay. So we're upside down in 2022. We do not have enough revenue to cover even just that first line item of payroll. Then we go and get into all the other expenses that we have going on. So our income before other expenses is a loss of $52,000. Then we have a few other expenses that are hitting, and we get down to a total expense of $113,000, which means we had a net loss of $63,000. Okay, so then just showing this over time. And then if we spent more time talking about what my sales projections look like, I have really great assumptions, and you would all agree that I'm 100% right in thinking that these projections are true. And we're going to get up to $318,000 in revenue by 2024. And our gross margin actually goes up a little bit because we're shifting our product mix. Our payroll actually doesn't increase a whole lot, but as a percentage of revenue, it drops to 34%, right? So our revenue is increasing much faster than our expenses are. And so we end up making almost $100,000 at the end of year 3. And so then just a nice simple graph to show that. We've got total revenue is the green bar, total expenses is the yellow, and then net income or loss is the blue. If you can make it fancier than that, then great. But I think making sure you have something like this is going to be pretty key for your presentation. Then we get to statement of cash flows. So this is where that line of credit comes in. As the template was set up, I set it so that if I dipped below my cash balance, if I went 0, that meant I was taking out money from a line of credit. So essentially taking out a loan. And so you can see as we go through, we have cash sales and accounts receivable. So that's cash coming in, 48,000. We're spending money, and then we've got interest on our line of credit. But you can see down below, we ended up having to take out $54,000, almost $56,000 in the line of credit just to stay afloat, so we could cover our expenses. So again, just a simple graph, taking that information, showing the cash inflows is the green and the yellow is the outflows. So obviously in year 1, that doesn't look good. And then our line of credit balance is that dark bar there. And then moving forward, then you can see the blue bar is our ending cash balance. So it's going up. So one of the things I would be looking at here is saying, why are you accumulating cash and not paying down your line of credit? Because you're spending money on that line of credit. So it depends on what your source of funding is going to be. We'll talk about that in a second. But that's kind of the end result here is how this all ties together, what these statements look like, and how you would start trying to tell that story. I mentioned at the beginning, I was going to get you through the statements and then a little bit past that. So The critical thing, volume and sales projection breakdown. I would very, very much recommend that you have a breakdown ignoring revenue, just looking at your product segments, your customer segments, and the volumes that you're going to get from those, and being able to explain how you came up with those numbers, just the volume projections, okay? Because that's the piece that will drive the entire business. And if somebody doesn't agree with you on your assumptions there, it's going to be really hard to move forward through the rest of your numbers. So you got to make sure that those make sense to start. And then you should look at a break-even analysis. So at what point in time or in sales will the business break even? So is it X number of sales that you need to have? Do you have enough growth over time that you'll be able to break even in a few months? So tie those two together. Look at a sensitivity analysis. So if you take your projected revenues based on your projected volumes, and then tie that with your projected expenses, essentially a very summarized income statement. And you say, what happens if my sales projections are off by 10 or 15%? And then model that out so you can show this is what happens if I'm off by 10 or 15%, because the judges or an investor will be able to say, you know what, I've seen enough of these, and usually the error of margin is 5%. And if you showed that if you're off by 10% and you still are getting a return within a reasonable amount of time, they might say, okay, this is actually a feasible business because the error of margin is not as great as what you're projecting, and you're actually showing a worst case scenario and still looking okay at the end. So it's about basically playing out those what if scenarios to show how sensitive is your business to you making errors in your numbers, essentially. Because again, everyone will know that none of this is right. This is all wrong. It's just about making it useful. And so doing that sensitivity analysis is one more thing that will make it that much more useful. And then you should be spending some time talking about, or thinking about at least, your sources of funding. So looking at your cash flow statement, how much are you going to need? How long will it last you? Where are you going to get that from? The amount that you need to make it to the point that you get, that big sale or whatever it is before you are break even, or you being able to be self-sustainable. So looking at investors. So are you going to put the money in yourself? Are you going to get it from friends and family? Are you going to get it from an angel investor? You need to think about how much equity you're willing to give up. You could go to a bank and get a term loan. So that would literally be, I'm going to take a loan out and I'm going to have to pay it back in 5 years. I would say banks probably aren't your best bet if you can stay away from it. They're not going to be real inclined to give you money when you have no credit history and you don't even have any revenue or really much of any business to show. So that would be hard to acquire. And even if they did give you one, the rates and all the parameters would probably be very, very restrictive. So it's probably a lower level choice. But again, it all depends. And the last piece, if you can get to it, I would spend some time talking about your key performance indicators. So if you're talking apps and you're looking at daily active users, weekly active users, new subscriptions, returning customers, customer acquisition costs, looking at all of these other metrics that will help not only you to show. I'm thinking about in terms of once the business is up and running, they'll help you manage the business. So pre the business running, you'll want to talk about, here are the KPIs that I plan on measuring, and here's why I'm going to measure them, and here's how it's going to help me run the business, and I'm going to aim for keeping this particular metric, at this target, and it's going to result in X, Y, and Z for the business. So again, it's unit economics, but sort of turned on its head a little bit. And you're talking about management indicators and management metrics. Okay, so final thoughts. I'm finally done. I don't know. I probably went way over on my time. But I think the main thing here is just get started. Get started. It's going to take some time. So just start. It is a big burden and it's onerous. And if you don't like Excel and you don't like finance and numbers and stuff like that, then it's not going to get any better the longer you wait. So just get started. Own it, own the template, own your models. If somebody else is doing it, if you're the CEO and you've got a CFO doing it, you should still know those numbers. Okay, so make sure you own it. And if you're using a template, you can't use the excuse of, well, this is just how the template did it. That doesn't work. Okay, this is your business. This is a real thing. And you need to make sure that the numbers flow how they should and everything is lining up how you want it to. Like I said before, build it, test it, rework it, retest it. You're going to go back through and scrub these things over and over and over again to make sure that they're dialed in how you want them. Be honest with yourself. Okay, so don't be making wild assumptions that in the back of your head, you're really questioning if that's reasonable or not. Okay, so go back to that reasonability test and make sure you're being honest with yourself to start. Because if you're serious about taking this business forward and doing something with it, you're going to want these numbers to be real. Otherwise, you're going to be in for a rude awakening and you don't want to find yourself in that position. And the last thing is just know your numbers. So for your presentation and being ready for questions, again, in your presentation, you'll summarize information and you'll show the key points and you'll tell the story how you want to tell it, but you're going to get asked questions about, well, how did you come up with that number? So make sure you understand and you can remember what are all the components that go into that. And they should all just flow together and just, know your numbers. So I think that's it. That's all I got.
Well, thank you so much, Ryan, for sharing your all the best practices for doing income statements. And I know we probably have a number of questions. Like I said, we have a number of students on who are from ag tech and from tree fruit. So I know if you have a couple minutes, I'm sure there are some who would like to ask you questions about kind of your current work. You've worked in finance in two really different industries. So we may see some questions pop up around that. I'm also curious, maybe just as a quick warm up, real quick question. Do you remember what was your business idea for the business plan competition?
Yeah, I went and pulled up our old business plan to just get my brain going for this presentation. And yeah, so it was a company called Sakin. It's a Japanese word for clean. And we did a whole business around a self-sanitizing countertop to put into hospitals. So our sales strategy was all around selling to a hospital, and a hospital has average of 196 rooms. So, X number of countertops per room. So we had all that broken down and cost estimates and all that. And it's pretty funny. I was texting with my business plan teammates just yesterday about how many different UV sanitizing solutions there are out there now for hospitals. And we're like, man, we could have done something with this.
That's great.
Brian, did that help you get your job at Virginia Mason?
No. No, even doing that as a business plan, I never, ever thought I'd go into healthcare. And then that's what I went into. So
did you talk about that project in any of those interviews?
I don't think so.
Okay.
It wasn't super relevant, but as far as, because, just being a business analyst, I don't know that they're like, well, and especially with DaVita, they don't do, they're not a hospital. So it wasn't as
Apple. They're mostly dialysis work. Is that right, DaVita?
Yep.
Yeah. Okay, great.
Yep.
Okay. Do we have any quick questions in the chat before we head to breakout rooms?
Well, Ryan, I got a question for you. In the beginning, you said that you thought our presentation should be a lot more detailed and your presentation wouldn't cut it. What did you mean by that? Can you give us some more details? Like, what would you like to see if you were a judge?
So that's a good question. And I'll have to say I'm not a judge. So I don't know all the criteria, and maybe Marie can speak to a little better, but I can say from what I was showing, in general, the two main things I would say between my presentation and what you should be focused on doing is summarizing that information better. So don't just take a snapshot of the template and just paste it in. Because yeah, those things are good to know, but that's probably too detailed than what you need to be getting into in the presentation. Some of that stuff, maybe you take it and you put it in the plan, like as an appendix. But as far as the presentation goes, it should be much more summarized. And even when it comes to the assumptions, I would say talking through the assumptions around your sales plan, but that all ties in with your go-to-market strategy, your customer segmentation, so all of that should really kind of flow together, because you'll talk about all those pieces and then you'll say, and by doing that, it will result in XYZ sales, which will result in XYZ revenue. We've estimated our costs, and you talk about the big buckets of costs, because I don't think the judges or investors are going to try and hammer you in your presentation on, was your rent expense reasonable or not? But what they might do is pull up your plan, your detailed plan, flip to your income statement and go look through the details there. So it depends on if they care about that stuff, they'll go look for it. But for your presentation, it should just be more summarized. And I know not everybody is a marketing person, and I wasn't. We had a marketing person on our team, but you should spend some time to just make sure it looks nice and it's consistent. I mean, mine, I'm a stickler for formatting, so I tried to make it look nice, but I just did copy paste, a picture into the PowerPoint template. I just don't do that, because like somebody like me, I can tell that that's a picture of a spreadsheet, so make it look nice. Yeah.